A Delaware Statutory Trust is just another form of a 1031 exchange. So this is a part of what they call the old blockbuster way of doing things, although it does have some real benefits. So let's start with some of the benefits. One, you can trade investment property and you can trade your interest in your equity. You can move it into the interest of a Delaware Statutory Trust. Typically, these Delaware Statutory Trusts are run by large institutional type of real estate owners. And so one of the groups we've worked with, they're the 10th largest in the United States. And I've had clients who wanted to get out of the toilets, the trash, the liability, and wanted to be completely passive and just move it in there and just get a check. Okay, so that's good. Second thing is they have institutional debt, and it's non-recourse debt for you, and it's debt for them. So you're not putting the debt in your own name. So I like that too, because it's also lowering your risk. Okay. However, some of the challenges still apply for the Delaware. You're typically selling high and buying higher 180 days later. Okay. You also must identify, like Matt was saying, this is one of your products. And sometimes exchange companies make you identify if there's a portfolio of Delawares, all three of your products. Now you're really locked in for just those. So you got to be careful with the Delawares. You want to make sure you're buying it based upon the value, making sure you're buying it on the cash flow. But a lot of those deals are around 5% return, honestly, and they're high fees. Financial advisors sell them. You can't just get them through your commercial real estate broker. You have to go through a securities licensed individual, and that's part of what I did. I got my Series 22 and 63, and I've helped clients do some Delaware Statutory Trust over the years. But it's really kind of the secondary option, and I believe it's more of a blockbuster way of doing things. Some of the downsides are the high fees. You also lose all control, meaning you're giving up all of your cash and you're putting it into typically a single entity, a single group for the next 7 to 10 years. Okay, so you're going to get cash flow, but you can't just get out. Okay, and also with the 1031, as a part of that, the whole entity must move. So you're trading your one asset into just one other asset. So if you're looking for liquidity, if you're looking for diversification, if you're looking for flexibility with when you go back into a real estate deal, the Delaware Statutory Trust is not your friend. But if you're looking to be completely passive, have no debt in your name, and get a check around 5%, then that might be a good fit for you.
So if you're doing the Delaware Statutory Trust, would you say that the Delaware Statutory Trust offers more flexibility or less flexibility if someone wanted to take their 1031 and say go into a syndication, a private real estate deal with a sponsor, or maybe an ozone deal?
Yeah, typically less, because here's the thing. The 1031 structures and the clients we work with, the whole entity must move. And again, remember those three properties you talked about. So 1, 2, or 3, you have to close on 1, 2, or 3 of those. So you're generally trading one asset for one other asset, okay? Or one deal to one Delaware. So it's very restrictive. It's like going to Blockbuster, right? You had to show up on a Friday night. You had to, hopefully the movie was there. If you even got it, you have to return it within 3 days. If you didn't, you got a fee, you got a penalty. That's like Blockbuster way of doing things. That's like the Delaware. Yeah. It's very, very restrictive. You need to be an accredited investor. Okay, there's a lot of things that are forced there with the Delaware. So I would say it's definitely less restrictive, especially versus the opportunity zone, the deferred sales trust, which we're going to talk about here in a minute.